and welcome to DigFin VOX, Voices in Digital Finance. I'm your host, Jame DiBiasio. If you enjoy the program, like, subscribe, you know what to do. My guest today is Samuel Rhee, co-founder and CEO of Endowus, a Singapore-based wealth tech company. I spoke with Sam about Endowus' latest capital raise and the challenges of raising capital today, his use of the proceeds to help him grow into Hong Kong, his plans to disrupt private banking, but also trying to make ordinary pensions easier for all of us to figure out. Samuel Rhee, welcome to DigFin VOX.
Great to be here, James.
Yeah, my pleasure. Endowus is one of the leading wealth tech businesses in the region. I invited you on because you have some news about a recent raise, and we'll get into that. But really, just an exciting time, I think, for the wealth tech sector in both in your hometown of Singapore as well as your growth market of Hong Kong, where I am. So, wanted to, just a great excuse to get you on the program.
Great, it's great to be here, as I said, James, and big fan. So yeah, let's talk about fun stuff.
Okay, well let's get straight into it. So. Before you helped found Endowus, you were for many years, 17 years plus, you were at Morgan Stanley Investment Management, and you worked your way up to running the whole thing for Asia, I think, right, at one point. So you have huge experience in global asset management. So I'd like to talk a little bit about kind of the start of Endowus before we get into the future. And I'm sure you've told this before, but I'd like to understand, what is it that you couldn't achieve while you were at Morgan Stanley Investment Management that you had to create a startup to go do this?
Yeah, first of all, I think I had a wonderful first inning, as they call it, which was in traditional finance, institutional kind of business. I was in the asset management side of Morgan Stanley most of the time, and so I ran money. So I was an investor. An institutional investor primarily because they didn't do retail. So I invested like sovereign wealth funds, money, pension funds, endowments. Those were our clients. And my primary responsibility was investing in public markets as opposed to private. And also Asia emerging markets was my specialization. So I was a good investor, obviously, because I got promoted, and then I took on the chief investment officer role, and then I took on the CEO role for Morgan Stanley Investment Management across Asia, ran the business a little bit. But always, at the heart, I was an investor. And being an institutional investor, you get a lot of advantages. So you get access to great information, great access to management, research, great advice. And then you get access to great products. And you get it at institutional cost, which is really low. But then the moment I step away from my role and try to invest my own money in the retail space or even through private banks, including Morgan Stanley, where I was, it was a completely different experience. And oftentimes I'm always frustrated with my own experience. So that's the first thing. Okay. Is that my own experience and the frustrations, and likewise for my co-founder, Greg, who used to be at UBS and Grab after that. And all of my colleagues, a lot of us have come together because of our own frustrations with the existing experience in the wealth industry and investing our own money. The second thing, though, is that I'm a very macro person. And, I'm very curious about developmental economics, the political economy of, nations and all of those things. And one of the things that I really honed in on was the massive global pension crisis that, societies are facing across developed and developing nations. And in Asia, that's front and center in every nation. So, global pension crisis in which, and as an individual, it means, right, trying to solve our retirement adequacy problem. And I realized that there is no real player in the business, whether it's traditional or new, digital or offline, who actually do a good job of that. So I felt there was a massive opportunity. And then in Singapore, we have something called the Central Provident Fund. In Hong Kong, we have the Mandatory Provident Fund, CPF, MPF. Both are pretty bad experiences, to be honest, right? And outcomes have been poor. So we thought that this was a unique moat business that we can build technology around. Previously, there has never been an end-to-end kind of digital solution for that. So we really came together to build and solve the individual investing problem, the big goal of retirement adequacy that every individual faces, and more broadly as a society, and then applying technology and innovation in digitizing a completely offline experience with poor outcomes and high cost into a wonderful experience and better outcomes through lower cost, better advice, and better access. So that's really the genesis of Endowus.
And before we get into that a little more detail, I just want to stay with this question, this overall question of, we're still in a position where the existing industry, despite all of its resources, I mean, they know about all these things, they research, they talk about the same problems that you just elucidated, and yet it's still up to fintechs such as Endowus and your competitors to kind of drive that innovation, make that change happen. I don't really see global asset managers or the distributors who have even more at stake, I guess, with the status quo, able to come up with these innovative things. The best they could do is maybe take a stake here and there. Why is that? Why do you think there's just this incredible logjam on the buy side industry?
Well, I think there's two things. One is that, look, we have to separate the asset managers, who are, we call the manufacturers of financial product, right? So they actually run the money as a fund professional money manager, as fund managers. So they build product and solutions, right? But they don't directly interact with the customer, the individual investor. They are in institutional business at large, right? And they have to go through an intermediary who are the distributors of funds. And normally that's banks and brokers, and we have fund platforms now that distribute funds, and then you have guys like Endowus who are financial advisory at heart, right? In the US, you have RIA models, which are independent financial advisory models. In Asia, unfortunately, that distribution of financial products is very broken because the traditional banks have dominated that segment, whether it's HSBC in Hong Kong or DBS here in Singapore. The banks really dominate the distribution of financial products, especially unit trusts and mutual funds, which are the primary source of indirect investments. And the market's not big enough like the US to have like ETFs and, low cost options, passive options and stuff like that. And so, fundamentally, we have a problem because the most innovative players, they've tried to launch like target date funds, some kind of retirement research and solutions. But really, that's the role in the US, especially, and Europe, and closer to home, Australia. That's the role of a financial advisor.
Yes.
But in Asia, that role of a financial advisor is largely non-existent. It's taken on by a commercial bank, whose primary job is to deposit, lend, sell credit cards, and they're not sophisticated in the business of wealth. And same thing with private banks. Their biggest weapon is actually leverage. Providing low-cost funding, rather than really solving an individual's problem of preparing for the financial future, personal financial planning, and all the things that are advisory in nature. So you have a massive dislocation, and then the distribution and the guys who are providing advice have massive misalignments. So there's no independent advice. There's no there's a lot of conflict in the way funds are distributed or unit trusts are distributed. So, the inherent problems that exist in the financial service industry, especially the wealth industry, is something that is not going to change because the banks and brokers are making a lot of money through fees to charge to the individual, but they also get paid by the asset managers who are paying these distribution guys to distribute the funds. So they're taking from both sides, which is something that in the developed markets regulation has changed. Or, if the consumer is very highly literate in financial education, then they can be more discerning or push for change. But in Asia, I think that's also a problem from the demand side. So there's no pressure. And it has left to guys like us, Fintech, as we call it, to really try to disrupt that business. And so, it's something that's unfortunate because they're not going to change because it's a very profitable fat fee business. And it's, trying to let go of that is very difficult for incumbents.
So I think Endowus is probably best known. I guess your version of the WealthTech offering started with CPF in Singapore, connecting people to their CPF account. Because most people in these regimes. Myself in Hong Kong, I have this pension pot. It's basically a government mandated scheme, even if it's and in Singapore it's run more or less by the government. In Hong Kong it's distributed, but it's a mandatory scheme. And it's not connected in any way to anything else that I do. It's this silo. And if I might have a brokerage account, I might have an investment account or some funds or my bank account, but there's no communication between that. I can't have a holistic portfolio that includes what's supposed to be a very key part of my retirement saving. So as a result, it gets ignored mostly, and the service is bad. So what was the way that you found, whether it was APIs and tech, or just getting the right people in the bureaucracy to sign off on things to be able to integrate somehow your customers' CPF holdings into a broader range of all their financial activities?
Yeah, no, it's a fantastic point, because our premise was that as an individual, we need to have a holistic approach to our financial planning and preparing for our financial future. And in Singapore especially, and MPF in Hong Kong too, is a meaningful part. In Singapore, it's actually massive. It's 37% of an individual's income. Hong Kong much smaller. But nevertheless, it's a very important piece. And we wanted people to be able to see all of their finances and their monies from the different funding sources. And so in Singapore, we have the cash personal savings or private wealth. We have CPF, and we have something in between, which is SRS. So all three, we wanted to create a holistic approach to wealth. In order to do that, we needed to build a technology stack. So it was all in-house. It was built for purpose for CPF. And we reverse engineered from the current regulations, the current pipes and structures and design and regulatory frameworks, and figured out how can we build this in the right way. Now, it wasn't like the recent eMPF in Hong Kong, where it was commissioned by the government and you have a tender and PCCW won, that kind of process. It was really us coming to the government of Singapore, the Ministry of Manpower, CPF, and MAS, and saying, hey, this is what we want to do. And this is what we think we can do. And this is what we're building. Is this okay? Is this going to be, something that you guys will allow us to do? And so it was an iterative process. And it was a true venture. It was a startup venture, bootstrapped with our own money, without any product market fit, immediately. It was a vision that we went after because of those goals that we had to solve an individual's investing problem, to solve the distribution of financial product problem, to solve the pension and retirement adequacy problem. And CPF, because it's so front and center, we said, let's go after this. It's a massive moat business as well, and humongous opportunity, addressable, obtainable market. So we just built from scratch a built for purpose technology stack that end-to-end would seamlessly give an individual an experience from onboarding, investing, everything else in between, statements, reconciliation, everything, and pipe into the government. So the government there's no API. It's our basic full stack. And we've just gotten the approval from CPF and MOM, the government, to implement this. So we were approved as the first digital advisor for CPF. And as a result of that, we have a fully integrated wealth tech stack that can manage all of your source of funds. And we built it as a truly flexible, cutting edge wealth tech stack. And now it's portable to Hong Kong. We have to localize it to the Hong Kong's needs. And MPF is a different flow, different design, different pipes. And eMPF is coming, so we'll match it to that. But we want to build something that manages your personal savings, your private wealth, short-term liquidity, long-term investment, your MPF, and your also, for example, or your private pension, and just manage it seamlessly together. So that's the ambition of Hong Kong, and that's what we've achieved already in Singapore.
How deep is that competitive moat? You said you're the first digital onboarding. So how many other people are now doing this in Singapore? And I think Hong Kong will also be a different a different
Yeah,
story.
Hong Kong is a different structure with the trustees, and it's a much more open platform kind of structure. And EMPF is being built as an open platform. In Singapore, the government only had 3 approved investment administrator, which is a fund administrator.
Mm-hmm.
And every investment has to go through one of these guys. So it's iFast Fund iFast Navigator, which is owned by Singlife, and it's Phillip Securities, like Capital, right? Those were the existing incumbent CPF investment administrators. We wanted to introduce a new distribution framework of no commissions, no sales charges on mutual funds, 100% trailer fee rebate or retrocession rebate for any fees that we receive, so that we can remain truly independent. And it's the first of its kind, especially for CPF. And so, we needed to get an investment administrator who would work with us. None of the incumbents would work with us. So we went to a new player, and the government had to admit a new player to enable the technology.
A fourth player.
Mm-hmm. Yeah, which is UOB Kay Hian, our partner. And previously they had applied, and the government didn't feel a need for a fourth. But because of the Endowus business model of a low cost, investment option on CPF, they approved UOB Kay Hian. We built the tech stack, and the moat is absolutely a huge moat, because it took us 2 years, millions of our own money invested as a bootstrap company to build that out in the right way. It is possible for others to build, but no one has bothered to build it. Maybe once we scale, others may follow. None of the other robos are able to do it because of the unique way we approach the regulatory framework. And as a result, we're the only digital player, independent player to be approved. DBS or iFast, other guys can do it, but it just doesn't feel like for them it's a priority, because in a way, they would be giving up a lot of fees in order to enter this market. And we've already priced it at the lowest possible offering. And so we've worked with the CPF to price it in the right way. We actually have exclusive offerings. Some of the lowest cost passive index funds are only available on the Endowus platform for CPF. And we've introduced solutions that are not available elsewhere. So we have a lot of moats. The biggest one is technology. The next is access to products, and then obviously the cost.
Right. How big do you have to get before you start to scare the other people and make them think maybe make them regret not going into this more quickly?
Well, it's one of those things, Jame, that is a chicken and egg situation, right? Because if they already have businesses, which is the mutual fund distribution business, unit trust business, and it's making hand over fist because they take 1% or 2% of every fund on an annual ongoing basis. Right. And we're only charging 30 basis points to buy a mutual fund, or 40 basis points investing in your CPF. And the fund itself is half the price or 1/3 the cost of buying it through a bank or a fund supermarket. Then there's no way they can compete with us, almost ever, without giving up all of their profits. And they're a high cost structure. They're offline. They have branches. They have people in every branch selling these unit trusts. And we're a digital player, digital first, on an app, low cost. We have 10 client advisors advising hundreds of thousands of clients in a hybrid model, and they just can't compete. So in a way that they will be giving up business, and they may be okay with it, because in the big scheme of things, it may not be a priority for them, even if it's a business opportunity, and they probably won't be able to compete with us on cost.
Okay. So how big are you now? What can you give us some metrics and user and AUM for Endowus?
Yeah, I mean, the big picture numbers have been released. So over 150,000 clients in Singapore and Hong Kong on the digital platform. And we have over $5 billion US in group assets. So it's the digital platform in Singapore and Hong Kong. Plus, we acquired a EAM, external asset manager, multifamily office called Carre Private. So combined group assets is 5 billion is what we've announced. So we've scaled quite well. Every quarter since our beginning, even on the digital platform alone, we've never had a negative growth. Every quarter has been an up quarter sequentially, not year on year. Q on Q, it's been a growth. trajectory. Even throughout last year, we continued to grow net new money, total assets, revenues. So we reached peak assets, peak revenue every single quarter. 2Q23 was a blowout quarter for us. So we have good momentum of growth. You know, we feel like there's a unique generational opportunity to seize this digital wealth business opportunity.
And does that growth also equate to profitability? I mean, given the fact that you're so low cost?
Yeah, I mean, we priced it to scale. I mean, this is a scale business. We need to get to a certain scale. But obviously, we have heavy investments in talent and technology. Those are the two things. We spend on nothing else except talent and technology, and they're related as well, right? And all of that cost is upfront expensed. So we built a tech stack for CPF that may last us 20 years, and grow into that, but we've expensed it upfront, and we keep expensing everything. Yeah. So it's like the Amazon model, right? You're making a loss, but your cash flow is improving, you're growing tremendously. And it's that balance between, hey, how aggressive do we go that we're seizing a unique opportunity where we're scaling very rapidly and no one else can follow us. Now we are, you know, for example, guys, robo-advisors who started maybe 3 years before us are 1/5 our size, you know? So we're definitely dominating here in Singapore. We're way ahead of everybody else. We've overtaken and we're way ahead of everybody else as an independent digital wealth platform. And we're probably the biggest in Asia now, by far, I think. So we've scaled in the right way. And is this the right opportunity for us to, you know, in a way, invest to grow? Or do we scale back? So last year was a difficult year for all of us. Markets were tough. Growth was slowing a bit. And we definitely had to manage costs, whether it's marketing or, you know, headcount and et cetera, investments. But this year we feel much more confident. And I think our shareholders have backed us. New investors have come in with this fundraise, which gives us, you know, 3 years runway, a lot of commitment. And we were heavily oversubscribed. So we know that there's a lot of belief in what we're doing and how we're executing. So we feel that there's an opportunity for us to continue to grow a bit more aggressively, even though we're loss-making. And that will get us to profitability faster. So we think path to profitability is very clear, maybe 2 years. Singapore alone, standalone, will be profitable a little bit earlier. Obviously, new markets will have to invest and grow to scale as well.
What's the what was the key part of that narrative? Because right now the climate for all kinds of startups, if they're based on not making money but just growing eyeballs, VC subsidized businesses, effectively, obviously for many businesses that crashed and burned a while ago. So what was the key thing that enabled you to have a successful fundraise, even though you are maintaining that, you know, we need to grow it and profits come second approach?
First of all, I think we have a very strong existing investor base. So existing shareholders have been very supportive in this round as well. So UBS, the biggest private bank in the world, Lightspeed Global Ventures, Singapore's government's global investment arm, DBI, Process Ventures, which is owned by Naspers, the biggest shareholder of Tencent. You know, Singtel, Innovate, biggest retail distributor in Singapore. These are some of the shareholders that we've had, and they've come back in with very strong support because they really believe in what we're doing and the mission and vision of the company, but also because we're executing so well. So they've come in and supported us very well. I think venture capital funding is difficult, and it's not an easy environment, especially when it comes to valuation. And so, you know, the other problem that we face, though, is I don't think people really understand how differentiated we are, because people think, oh, Endowus is just another robo, you know, how's it really different? But there's so many things that are truly unique to what we've built. So the technology is completely different from everybody else. We have the public pension piece. We're the only digital platform that does private wealth and public pension, which is unique. We've really gone into the private wealth space with private markets and alternatives, where we have exceptional solutions and products that targets, you know, different segment of the market. That's very unique. We have the AM business, which is a profitable business that is unique. And all these things that are truly unique to our business And I guess the fund distribution platform, which is very unique as well. It's not a typical robo solution. So
despite all that, did you have to accept some, I mean, was this, we've seen deals that in recent months have been essentially down rounds, but they will keep the headline, but there might be covenants in the back. Was this were your investors quite aggressive in terms of the terms? Did you have to accept something difficult on this one?
No, we haven't had a down round in our history, and this round was actually a convertible. Mm-hmm. And we feel that the convertible, the range of outcomes, the floor and cap of the convertible will allow us to have another up round. So we feel that we've grown tremendously organically. Last year we grew 80%. This year to date we've grown more than 60-70% in terms of assets. Revenue's probably higher. So we're in and I mentioned every quarter is peak assets and peak revenue. So it's difficult to have a down round when you have good momentum. Okay. And so the valuation multiple has compressed in the public markets, and maybe we would have been valued much higher, and maybe it would have been easier to price around this time in a normal environment or a bullish environment like 2021. But we're okay with that. We're really in this for the long term. We're not hungry for valuation. We're not trying to push valuation aggressively. And we didn't do that when markets were bullish either. So we were much more tempered. And people came with us with term sheets with really high valuations. We didn't take it from them. We took it from the guys who are actually going to strategically build the business with us and contribute to our success. And really, if you look at our cap table, it's dominated by a lot of permanent capital. Right. So apart from Lightspeed, really every other capital, whether it's UBS, EDBI, government, or Prosus even, and Citi and MUFG this time around, or family offices, it's really permanent capital who are actually very knowledgeable about the wealth business. There are strategic angles where we can benefit from those shareholdings. And it's very purposely built cap table. And as a result of that, we haven't had to compromise on valuations.
What's the role of those family offices? So I noticed when you announced the raise that you, in addition to Citi and MUFG, you also mentioned 4 Asian families backing this round. Is there a piece to your business strategy where that's going to be an important factor, where you're looking to add product or add service that's more geared toward either high net worths or do something for the family office sector? Yeah.
I think, broadly, when we talk about the wealth tech space, people, include things like Robinhood, some people even include crypto, but we're a very different breed. So we don't have any trading on our platform. So no stocks, no individual names, no single securities, no crypto. It's all like indirect investments as well. So it's fund vehicles, whether it's passive index funds or money market funds for short-term liquidity, or active funds, that try to generate alpha, or private market alternatives, hedge funds. It's all actually indirect professional investment vehicles. So that's unique, but also we invest for the long term, right? So really, our digital platform is mass market. It covers affluent, maybe early Endowus private wealth, as we call it, early high net worth. But the digital first option is not something that is viable for a high touch private banking, disrupting high net worth, ultra high net worth business. Mm-hmm. And so that's where the acquisition of Corre becomes really important. But because the technology stack and the solutions on top of it and the advisory service is institutional grade. And by institutional, I mean like endowments, like Yale Endowment, David Swensen kind of like institutional quality. Mm-hmm. And that's where the name comes from, actually, endowment investing for all of us, like institutional endowment investment for all of us. And if you build it to institutional grade, then the single family offices, multifamily offices, EAMs, and B2B financial advisors, we actually, charities, nonprofits, endowments, these are quasi-institutional clients that Endowus can actually serve through our digital platform. We need a servicing center, right, that develops and nurtures that segment of the market. Right.
You still need that relationship, that human relationship management type of role.
Absolutely. So I think that's still very critically important at this stage. I don't think we can do it with a digital-only solution. And so marrying that together is playing to the strengths of Endowus and playing to the strength of Corre. And these family office relationships are great because they also realize that Endowus, for core wealth, they can outsource that to us. So single family offices and even multifamily offices are partnering with us to say outsource a centralized CIO office, outsource CIO services, the fund distribution platform, because we're the lowest cost way to buy a single unit trust or mutual fund because we've removed all the fees and we've gone to the clean share classes, and also access to private markets and alternatives, which smaller institutions don't get access to. So we launched a multi-strategy, hedge fund, diversified hedge fund solution that includes some of the biggest names, out there. And that's a solution we developed and solutioned because of our unique capabilities and the investment office advisory capabilities. So those are services that we'll offer to a broader suite of high net worth clients directly, but through single family offices, through multifamily offices, financial advisors as well.
How much of that business, from a revenue and a fee perspective, can you capture? So, if I am a wealthy family or have a family and I have maybe several private banks, and those private banks will provide me both investment services, and then they'll probably also fetch for me legal, trustee, legacy, philanthropy, art, children, wills, all that stuff. And I suspect that that's probably where the real money is in these things. Plus, they also then will also have their corporate banking arms and their investment banking arms and their teams, right, that they can do things for the corporate side of the family as well. So how, you've got this one you've got the low cost bit of that offer, right? You've got just the, we can provide you with core passive exposure, a little bit like this. And yes, you've got some hedge funds and some other capability, but are you able to, how much of that revenue capture that the private banks enjoy realistically are you going to be able to actually get? Just where do you see that going?
So Endowus digital platform and the fund distribution platform is effectively displacing the private banks. So we're becoming a digital private bank for core wealth, especially indirect investments, whether it's funds in public or private alternatives. We have access to a lot of solutions, more than 75 fund managers, global and local, private markets, alternatives, everybody that we're working with to build solutions with. So I think that critical element is displacing the private banks. Increasingly, though, a lot of people are leaving private banks and setting up an external asset manager or multifamily office business that sits between the client and the private banking custodian services.
Right.
And that layer is what the independent financial advice business, the RIAs in the US that proliferated, Europe and Australia close to home. There's a lot of people in that layer, independent wealth services. And that's what Corée is. So we want to own both pieces of it because we feel that there's a massive opportunity in independent wealth advisory. In Switzerland, the home of private banks, in fact, EAMs now account for 30% of the total private banking wealth. In Singapore, that's 3%. In Hong Kong, it's 5%. So we're very nascent in that development, but we already see a lot of people trying to leave private banks and setting up their own shops or coming together, setting up multifamily offices. And that's what Corée is. We feel that Endowus Family Office is a multifamily office business, EAM, that can scale to massive opportunity, that serves the client segment that I talked about earlier. But it also requires Endowus, the digital private bank, not the family office service, but the digital private bank, the infrastructure and the solutioning for the financial products. And that's where we can actually serve not just Corée, but we build the right solutions and products, then we can actually serve other multifamily offices and single family offices. And that's where the conversations have been very encouraging, that these family offices actually see us as an important partner that would displace the private banks. So we'll take over some of the business that they currently have with other private banks, and we will come in and service them as a custodian service provider. So I think there's two opportunities that are quite different in nature. And one where, we've solved the digital solution here, I think even in the EAM private multifamily office, there's no technology, but we feel that Endowus technologies can build something meaningful to improve the experience and the solutions as well.
And what's the long-term plan for Endowus? Are you going to go IPO?
I've been a public market investor all my life. I don't know why people want to do IPOs. Really, it's,
Well, some people have to get paid, right? I mean,
yeah,
the founders, the
liquidity.
early backers, they got strategic sale also, but liquidity event.
We want to build the first $1 trillion digital wealth platform in Asia. We think there's an opportunity for us to really scale meaningfully. It may take us, not the next quarter, but the next quarter of a century. But we're willing to really commit for the long term. And that's why having committed long-term permanent capital behind us, a dedicated mission-driven team that is deep fin and deep tech, critically important, because it's not just about technology, it's about understanding the pipes and solving the financial problems and the regulatory frameworks as well. So deep in deep tech, and we have the right team that we're building, and we're committed to building this out for the next couple of decades. So really committed to building it out. And yeah, who knows, maybe it's IPO, maybe it's strategic, but we'd love to just continue to building this out as we have done in the past 5 years.
Well, Sam, good luck with it. And maybe, I guess I'll have to catch you, we'll have to do this interview in another 10 years.
We can do it every year, Jame, if you want.
Okay, all right.
Yeah. See how we're progressing on that 10, 20-year plan.
Okay.
Yeah.
All right, good stuff. All right, thanks for your time today, Sam.
Thanks so much, Jane. Great to be here. Take care.